you will be actually converting some of the tax deferred dollars into tax-free dollars. And you could do a series of those the rest of your life. So what you turned was a management ethic into just a house you live in.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success.
All right, Dave, welcome to the show.
It is awesome to be here, Matt. Thanks so much for having me.
You got it. Well, we like to start with the difficult questions here. What's your favorite ice cream?
My favorite ice cream has got to be mango, coconut, pineapple.
You could not.
The mix.
So I love it, but you could not pick three more divisive flavors out there. I always tell people like coconut is one of those flavors. You either love it or you hate it. There's nobody that I'm like.
Exactly.
Yeah. Now you're joining us from St. Pete, I think. If we're down in that area, where can we get some mango, coconut, pineapple ice cream?
There is a place you can't get the ice cream, but you can get the gelato at Pachulio's down on the bayside in front of the banyan trees. I mean, I'm serious. You're sitting down there with your mango coconut gelato under the banyan trees, looking at the water. You could be in the tropics for all you know.
I love it. Well, I'll have to check it out next time I'm down that way. But tell our listeners, what's your scoop? What do you do today?
So where I'm involved at primarily today, first and foremost, I am just a frustrated, serial, ADD impacted real estate junkie. Throughout my life, I've never met a real estate deal I didn't want to try to do. I never found something that I didn't want to try. Always in real estate because I come from an old Kansas farm family that got our land in the homestead era. And so I was always taught from my earliest days that the two people who rule the world are the banks and the landowners. And you'd better be one of those. And they always told me, and we don't want to be a bank, so you better be a landowner.
I like it. Well, where did your real estate journey begin then in Kansas?
Well, on the farm, of course, we assembled farmland and stuff. But my true real estate journey, which is actually kind of takes us into what we're going to talk about today, the 1031 exchange, is an outgrowth of that when a Kansas farm boy met a Minneapolis city girl in Denver, Colorado, and they decided that he wanted to buy a sailboat and sail the high seas. Now, what is not in that picture anywhere? Ocean. We don't know what we were thinking, but we had our first child, and we realized that the greatest commodity we've got is time. They're not making more of it. You can't buy it. You can't get it. You can only use it well. And so we said, well, what can we do to maximize time with our family now that we're starting to grow it? And someone yelled, let's become real estate investors. It'll be easy, she said. And so Ready, Fire, Aim Dave bought a duplex in Colorado, fixed it up, rented it out, and then sold it. And thought I was the king of the world, man, until my accountant told me that I was going to stroke a $30,000 check to the IRS that year for that. And that's when I realized this was not going to work. That was not part of the plan of getting us to living on the boat, because nobody wants a silent partner named Uncle Sam. Mm-hmm. And so I went searching for a better way. And that's when I discovered a statute from the 1920s that was just starting to become popular called the 1031 exchange. And what the 1031 exchange allows you to do is to sell investment real estate. And instead of paying the tax, you use that to go buy new investment real estate. And you don't have to pay the tax in the middle. You get to indefinitely defer it. So that $30,000 that I would have had to have written as a check could have gone into my next purchase. And when you start thinking about returns on real estate, Let's say I make 10% of my money. That's $3,000 a year.
Mhm.
That goes a long way to buying seasickness pills and boat repair equipment, right? And you do that throughout your life. And what an amazing way to build your portfolio. So we started to do that right at that moment in Denver, Colorado. And over the next 10 years, using the 1031 exchange and also selling several primary residences where you get the profits tax free, we were able to buy a 53-foot sailboat with tax-free dollars and move on to it and raise our children for 10 years on a boat. We're living off the income from our vacation rental portfolio, purchased in part with tax dollars that we owed.
Yeah. I want to get into the nuts and bolts of a 1031, but living on a sailboat for 10 years has to have some interesting stories to it. And I'm just wondering, first of all, like, had you ever sailed before, or was this just an idea that you wanted to go do this?
I had sailed once on a lake in Kansas. My wife had never sailed at all, but we were trying to find what we thought was going to be an affordable way to do it. And sailing always sounds cheap, right? Because you don't have to buy gas. No. Yeah, exactly. It's not cheap at all. But it is kind of challenging and it is kind of fun. And we just took sailing lessons. And there was one time where a friend took us out of Ventura, California, as we were thinking about what to do. And he took us out right at sunset. So we sailed west into the sunset, and then we sailed back to that growing, that evening tide. And we just went, that's it. This is it. It was so beautiful. We were sold. But yeah, how Kansas and Minnesota and Colorado ended up on the ocean, I don't know. But it was awesome, and we loved every minute of it. The biggest thing that we realized was that we could be the rattiest boat there, but we still had the same view as all the mega yachts. And that's something you can't buy.
Yeah, I've always heard, and maybe you can confirm or deny, the two best days of a boat owner's life is the day they buy the boat and the day they sell it. Talk to us about the why'd you sell it? What'd you do?
Everybody says that. It's a lie. If you've done it right, it's a lie. The best day of our life was the day we bought it. The worst day of our life was the day we sold her. And all of our children would say the same thing. But unfortunately, when you're a family of 6 trying to live on a 53-foot sailboat, and your berths are like 5 feet 9 inches, and your sons are broaching 6 feet, the boat stops working.
Yeah.
And so we kind of came into a situation where it was time to go to college. It was time to do stuff like that. And so we sold her. But no, the years living on that boat were magical because we were together as a family. And I would encourage that for anybody, whether it's an RV or whether it's an estate in the desert or whether it's a sailboat. If you've got the opportunity to just back off the grid a little bit, spend some years with your family, maximizing that time, you will never, ever regret it.
Yeah, one of our dreams is to take a summer and kind of take the kids in an RV and go out west and see the entire country.
Yeah.
My fiance did that when she was much younger, and they still talk about it in their family to this day. And I would agree that.
See, it'll pass along, and you'll give your kids that kind of experience, and then they'll do it. And mom and dad will traipse along with their own RV. Oh yeah, it'll become a caravan. It'll be awesome.
Yeah. Awesome. Well, let's take us back to the real estate here. So if a 1031 exchange is a new word or concept for others, could you repeat kind of the definition and how we use it? And then I think you've got some different ways on why we use it.
Yeah. So again, the 1031 exchange at its basic principle is a sale of investment real estate followed by a purchase of investment real estate. And in the middle, by doing the process, you don't have to pay the tax that would normally be due, whether you have profit or whether you have taken advantage of tax write-offs and have depreciated the property out. Either of those things, that would have caused you to write a check to the government. You instead get to take that money and invest them for yourself. So basically, it's a way of compounding because you then get to make money off of the tax you didn't pay. And then you get to make money off the money you made on the tax you didn't pay. And you can keep that going your entire life so that you can harness that and really ramp up your portfolio. Now, it is a very strict process. So the devil's kind of in the details. Has to be investment in real estate. You only have 45 days once your sale closes to identify your potential replacement. And you have 180 days to close on it. So it's a fairly time-constrained process. You have to use someone called a qualified intermediary who does this for you. Now, when I found out what it was going to do for us, I immediately, some friends and I got together, we said, we need to be doing this for others. And so that's what we are. That's what I've been now for 25 years, is I've been a qualified intermediary doing 1031 exchanges for others because the government requires it. And we're kind of like your guide through Moria, right? Your Gandalf, if you will, making sure that you're going through the maze. And that's, title has to be the same in between the two. And in order, this is one that's really misunderstood, because in order to defer all the tax, you've got to purchase at least as much as your net sale, and you've got to use all your proceeds to do it. Now, there's some creative ways to get money out, but you can't just take money out, or you're going to have to pay tax on it. But you follow those 6 requirements, you'll defer all the tax. And we do an example with people where literally in 4 transactions over 20 years, one at year 5, when you wanted to start, then at year 5, year 10, and year 20. If 2 investors started with an identical $100,000 profit at the end of year 20, simply by doing 1031 exchanges, one investor owns $12 million in real estate. The other investor owns $4.5 million.
It's a pretty big difference.
The only difference, the 1031 exchange.
It's a pretty big difference. Now, you mentioned a qualified intermediary, and I just want to make sure that we double down on this point, because the first time I ever tried to do a 1031, I sold a triplex for, I don't know, a $180,000 gain. I thought I was on top of the world, received the funds. I'm like, all right, it's time to 1031 this. And that's when I found out that the 1031 had a couple caveats in there. So it's important that you find folks like Dave out there that can help you guide through this process, but maybe define what a qualified intermediary is and how do we find a QI?
So a qualified intermediary, literally all they are is an unrelated third party who you don't have any other business or family relationship with. Their only job for you can be processing the 1031 exchange. Now, what's most critical, as you found, is they have to be involved prior to the closing of your sale. Matt, you're not alone. I get calls every month from someone who says, I closed my property last week. I left the money with the title company. I'm ready to do a 1031. And all I can do is weep with them.
Yeah.
Because as soon as they touched the money, as soon as the property closed without the intermediary in place, the tax is due. So yeah, you're absolutely right. That's critical. But we really are just an unrelated third party. Typically, we are, like in my firm, we're attorneys and accountants. But this is all we do. I'm an accountant. I don't do taxes. My partners are attorneys. They don't do trust law. All we do are 1031 exchanges. So there's kind of a closet industry that's out there. But folks do want to be careful, because the only qualification that makes you qualified is that you are not disqualified. I can't make this stuff up. This is right in the statute. You're qualified unless you're disqualified. And you're only disqualified if you have a relationship with the client. So Your dog walker cannot be your 1031 intermediary, but your friend's dog walker could. Your accountant can't be your intermediary, but the car salesman down the street you never worked with could be your QI. So simply saying I'm a qualified intermediary for 1031 exchanges doesn't mean anything. You want to ask questions. Make sure that they've maybe got that level of professionalism. They're accountants, they're attorneys. They've got some longevity so they understand the law. Because it's not just about filling the right forms. You got to make sure you don't step on any of those landmines like you did.
Yeah, let's also talk about. I've heard some horror stories about QIs and them not being insured or bonded or even legitimate. So if I get a QI on the phone like yourself, what are some questions I could ask just to make sure I get some due diligence done on my end too?
Yeah, the best thing you can do far and away is talk to people who've used them in the past. A good QI is going to have been around. So it's not going to be like, well, we've been in business for 3 years. That's a Johnny come lately. And you don't know what their level of expertise is going to be. So talk to people who've been doing business with them for 5, 10, 15, 20 years and find that expertise. Now, you make a great point about bonding and insuring because typically I'd say 98% of qualified intermediaries, they hold everybody's proceeds in a pooled trust account or escrow account. So your money, my money, everybody's money is all together. So that's quite a bit of money. In our case, it could be $80, $90 million at any one time. Now I ask you, who's got more temptation when there's $80 million in an account or $80,000 in an account? So right away, the more you cluster that money, the more worry you're going to have. Secondly, because our money's pooled, you might have a closing scheduled next week when I decide to file bankruptcy. Well, if I file bankruptcy and my money's in there with your money, the first thing that happens is a receiver's appointed. And with the receivers appointed by the court, that account is closed, is shut down.
Yeah.
Now, you're not going to lose your money, but you might miss your closing date, right? So there's a problem there potentially. The other thing is that part of this is solve people think with insurances. And insurances are important. I get it. We all carry them. But insurance is also only good once a bad problem has happened. So the idea is, how can we maybe prevent some of the problems from happening? And what we discovered years ago was that just about every problem where a QI goes rogue and takes somebody's $50 million is because they had access to take $50 million without anybody questioning them. And they say, but they were insured. That doesn't help you get your money back that much. So just one thing I would suggest, it's not required, but what we do is we've chosen to set up individual FDIC insured accounts in every exchanger's name. So if you do an exchange with us, Matt, you get an account that only has your money in it and you're a signer on it. So money cannot leave without your signature. So that protects you from me. No matter how much I want to take your money, I can't because you have to sign. Now, we are also signers on that account, but it takes both signatures. And that's what protects you from the IRS because they don't want you to have constructive receipt of the funds. So I would say those two things. Talk to people who have used them, find out what their experience has been, find people that truly are protecting your money before a problem happens and not just insuring themselves for after a problem happens.
Yeah.
And talk to title companies, talk to your real estate agents. Those are typically where we get referrals because once we start doing something for a title company, they like our work, they just keep calling us back. And so if you ask a title company, Do you have a QI you regularly work with? They're probably going to tell you.
Yep.
And that's going to be a safe bet.
Gotcha. Yeah, I didn't even think about the pooling of the money. And if somebody declares bankruptcy and your money is mixed with theirs, all of a sudden you get a frozen account. That, or even worse, it's an SVB situation. Now you got to go through FDIC insurance and all that. That's crazy.
I've seen it happen.
You've mentioned a couple times investment properties. So just to clarify, there's no 1031 for personal residencies. These are investment properties only. Is that correct?
Yeah, that was taken away in 2018. It used to be you could do equipment and things like that. Now it is only real estate that is held for productive use. So it's not your primary residence. It's not property like you buy as a fix and flip, because your intent is not to hold it. Your intent is to sell it. But all other than that, any type of real estate that's held for investment works.
Gotcha. I want to hit you with a couple common questions that I typically get from investors. Then the first is, I'm owning a duplex and I want to 1031 it into a small apartment complex, not like a syndication. I own both. Or I want to roll it into a self-storage facility. So both of them are investment properties, but not the same use. Can I do that?
Hey, fellow investors, before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
Absolutely. So the definition of like kind, it's called a like kind exchange, is that it is real estate. Like kind is any type of real estate. So you could sell residential, buy commercial, sell raw land, buy industrial, sell single family, buy multifamily. That doesn't matter a bit. Like kind is any type of real estate. The second phrase that's used is qualified use. Qualified use means it's real estate that you've held for productive use in trade or for business or for investment. So when you think about all the different kinds of real estate, could be agricultural farmland, could be an apartment building you rent out spots in, it could be the building you have your restaurant in. That's all qualified use. So it's really quite a broad application, isn't it?
Gotcha.
As a matter of fact, those people that are asking about duplexes, let's talk about a real common hack for people initially getting into real estate. We've got more time and energy than we do money, right? We're just starting to build it up. You're starting your first career. Maybe you're just going to college, but you scraped enough money to buy a duplex and live in half of it. What you've got is a mixed use property. You have a property that's half your primary residence and half of it is investment. So you go through college, renting out the other half, and that's paying your mortgage. You decide now's the time to sell it. Well, when you sell that, you're selling two different kinds of property. And the half that's used for your primary residence, if you've lived in it for at least 2 years, the first $250,000 of profit on that is tax-free. You could do that every 2 years. So we've got clients that make a career out of buying small multifamily properties because you can get primary residence financing, even though part of it's investment. And then the other half, you 1031 exchange. So you defer all the tax, 250 of it or 500 is tax-free. And what do you buy? Another small multifamily property and do the exact same thing over and over again.
Yep. Swap till you drop. Our
That's the word.
The second question I typically get is, hey, I've owned a couple single family, multifamily, active real estates and Airbnbs maybe, and I want to roll it into a passive syndication deal. Talk to us about some of the ways that we
Got
can
it.
kind of navigate that situation.
So if I could back up just a second, the ways that the 1031 is used. So first of all, we talked about deferral, well, how powerful that is, right? And then we just got done talking about what I call the second D of 1031 investing, which by the way is also defer, because you can meet the market wherever it is telling you to go. You can exchange any type of real estate, like we talked about, into any other type of real estate, anywhere in the country. And so you can exchange to get better appreciation. You can exchange to get better cash flow. You can exchange to get out of California and get into Kansas City. All of those things will let you meet whatever the market is telling you to do. Now, what you're asking about is the ability that the 1031 exchange gives you to adjust to wherever you're at in your personal journey and life cycle. Because we're not the same investor today that we were yesterday, and we're not the same investor today that we're going to be tomorrow. Our needs change. And like we talked about early, where we've got more energy and less money, that's a great opportunity to start to diversify. Sell one property, buy two. Sell two, buy four. Get bigger, grow, grow, grow. Buy value adds, because I still feel like swinging a hammer. So let's go for it. But at some point in time, you realize that you're kind of starting to get tired. And you want to maximize time. So rather than doing all the work yourself, you start to find ways of going passive. Now, some of that might be you're having family. So you do a 1031 exchange, sell some of those properties and go buy a vacation rental where it can be managed and you can get some personal use of it. What a great way to start building memories with your family and still holding investment property. Another way to do that is to sell an investment property that you manage yourself and say buy larger multifamily properties where you can have them managed in-house. Another opportunity for passive is triple net commercial properties where the tenant pays taxes, insurance, and maintenance. All of those things are great ways to move into passive. Delaware statutory trusts are sort of like syndications, but the IRS has blessed them for 1031 exchanges. Fractional ownership of a large asset, like an Amazon distribution center. And you can 1031 into that. Again, what you're doing is you're getting away with your active work so that you can just sit back and start to collect the checks. And I think that's a great way to do it. One other hack for going passive that nobody knows about, very well, if you talk to me, you do, and all of your folks are going to now, is the idea of converting. So you 1031 exchange, and let's say you 1031 into a really nice vacation rental near where you want to retire. So at some point in time, when you're ready to retire, you're going to sell your primary residence, wherever that is. And what you're going to do is that money's tax-free, right?
Mm-hmm.
And where are you going to move? You're going to convert your former investment property into your next primary residence. As long as you own that property, you don't pay the tax. But you just got yourself $500,000 tax-free. And now you got a place to live that you're still going to have to pay the tax on. And the longer you live in that, you will be actually converting some of the tax-deferred dollars into tax-free dollars. And you could do a series of those the rest of your life. So what you turned was a management headache into just a house you live in.
So I want to make sure I caught that last one. So if I have a duplex today and I'm getting closer to retirement, I know I want to retire down in Florida and the Keys, let's call it. I can go buy a vacation. I could sell the rental, 1031 it into a vacation rental. And then 3 years go by. I decide, okay, I'm ready to retire. I could sell my primary residency, move to the vacation, and now start the 2 year out of the past 5 year conversion at the vacation rental.
That's correct. Now, the one caveat is that you won't get the full 250 or 500 free when you sell the investment property. You have to have owned it for 5 years. You have to have lived in it for at least 2 out of the 5. And then when you sell it, you get to prorate and take the amount of money profit for the amount of time you lived in it tax free. So here's how one of my clients 10x'd this. He sold a couple of properties and he used them to 1031 exchange into 3 identical condos, beachfront on St. Pete Beach. Okay, nice plan. And then he retired. He sold his primary residence. That money was tax-free. So that started his retirement, right? He moved into one of those condos. You see where I'm going.
I do.
He lived in that condo for he rented it for a year. He lived in it for a couple of years, and then they sold it. Well, he got 3/5 or 60% of that gain tax-free.
Mm-hmm.
Where did he move?
Next door.
And doing it again. So his retirement plan, I just live in a nice condo and look at the ocean. Because, hey, if I had to deliver pizza or bag groceries, I'm still paying tax, aren't I?
Yeah.
So this way I'm still going to pay a little bit of tax, but I'm also getting some tax free. And you can daisy chain those together for as long as you want to live.
Yeah. That's one thing I love about real estate in general is just how creative you can be when you understand all the tools in the toolbox to go implement. Dave, last kind of question I get on this is, we were chatting a little bit beforehand. I had someone call me a couple of weeks ago and said, hey, I'm about to sell one of my investment properties. It's got a $25,000 gain. I want to go 1031 this into something else. And I said, let's take a look at this because the cost you're going to end up paying for a 1031 might not make sense for you to do that on that small of amount. Maybe help us understand what are the costs really associated with structuring a 1031 and doing this process?
Yeah, so like anything, there's really no set structure from the government. So it's different than like title companies and realtors and that kind of thing. So, but what you'll find, just kind of as a general rule of thumb, is that you should be able to get a really good exchange for a garden variety property for less than $1,000.
Okay.
So for $1,000, so now you're absolutely right. What you want to do is look at what your gain situation is going to be. Now, in your client situation, with a $20,000 gain, they're probably going to pay 15% federal, and most states will have another 5%. So they're looking at about like 20%. So that's $4,000. So for them, the decision point is, I'm going to spend $1,000 to save $4,000. Is that worth it to me? Some people might say yes. Some people might say, the hassle of going through the 1031, maybe it's not. But honestly, for most people, it becomes a very small price to pay to at least try. Because what we find, even when the market was at its hottest, 92% of our clients were still completing exchanges. And, these were people with $30,000 to $70,000 of tax from their gains, right? $100,000. If you're in California, you make a measly $100,000 on your property, 40,000 of that is going to the IRS in California.
Yep.
That's ridiculous.
Yep.
So, if they've got a $50,000 tax bill and they could do an exchange for $1,000, well, there's no penalty for not completing a 1031. So if I told you today that I was selling you lottery tickets for $1,000 each that had a 92% chance of winning $50,000, how many would you buy?
Yeah.
I mean, I'd go to the bank and borrow to try and do that. So it's definitely usually worth your while financially. Emotionally, psychologically, that kind of depends. But my favorite client of all time was in Cape Coral, Florida, back in '03, I think. And she sold a lot for $10,000. And by the time she paid her exchange fee, she was going to end up saving $500 in tax overall. And I asked her, I said, you sure you want to do this for $500? And she said, Dave,
It's my money.
that $500 is mine.
Yeah, it's my money. I get it.
I said, fair enough, let's do it.
Yeah, I understand. Dave, we didn't go into all the fancy tricks around cashing out some of these 1031s, reverse 1031 exchanges, all of those sorts of things. I'm just going to say that we'll leave links in the show notes for people to reach out to you to learn all the different ways that you can kind of use this tool to maximize your advantage. But I want to switch us now to our last round. We're calling this the 4 toppings. Our first one is, what is your favorite book, or what is a book that you've read recently that's given you a paradigm shift?
Oh, that's given me a paradigm shift. I think there's a book that I'm reading called Radical that is calling us to move from attitudes of judgment to attitudes of love, and to start to look through other people's eyes at what their situation is. We've been a very scared people for a bunch of years. I mean, with good reason, right? COVID and all this stuff. And we stopped rethinking that other people might be just as scared as us. And it's an idea of thinking radically and starting to love others first. Leading with love is what it's called.
Yeah. Boy, don't we need some of that right now. Our second one is, what is the best piece of advice you've ever received?
Well, someone said marry that girl, and you should have married her early. That was good advice. I didn't take it. I waited too long, but I still got her. I think the greatest real estate related wise, it's the idea that you don't have to live in a microwave. Be patient. As long as I've been alive, I've never been patient. So I get it. I've paid the price. I got the scars. But what I've learned over time is that cycles come, cycles go, and they are the same. Anybody that tells you this real estate environment's a new paradigm, it's never going to be the same again, is not telling you the truth.
Yeah.
It comes and it goes. And if you miss this one, you're going to get another chance. So patience is the key. I'm fond of telling people that it's not the deal that you don't get that's going to kill you. It's the deal you got that you shouldn't have. So be patient.
Yeah, it's funny you mentioned that. We can chat offline on this, but I'm doing a lot of reading around like the S&L crisis of the high inflations in the 70s causing the S&L crisis in the 80s. And like that's there's a lot of similarities to what's playing out right now. And I totally agree with you that I've never missed a deal that killed me, but boy, I'm suffering with 1 or 2 deals in my portfolio that are just kicking me in the shin over and over again. So our third one is, what are you most proud of in your life?
My family. I have the most awesomest family in the world. A wife who's a true soulmate, sailing partner, kids that still call themselves sailboat, sailor kids. We've had a great life, and I love them all.
I love it. Our fourth and final one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
I told you I was going to be thinking about this throughout the whole thing. I would sit down and have ice cream with Solomon.
Okay.
Solomon, the person in the Bible who wrote a lot of the Proverbs. But if you read Ecclesiastes, it's the most depressing book in the world. Because what he says is, life doesn't make sense. I don't understand anything. I'm so stupid. What does it all mean? Meaningless. Life is meaningless. That's a guy that understands life. And I want to sit down and have ice cream with him and see how he ended up figuring it out.
I love it. I love it. Well, Dave, thanks for coming on. Very valuable for me to learn up all on 1031 exchanges and brush up my knowledge there. If our listeners wanted to reach out to you, learn more about what you've got going on, where is the best place we can point them?
Yeah, I would say come right to our website, the1031investor.com. We've got calculators, access to a YouTube channel. By the way, please go there and like and subscribe because we're putting out shorts now that so many things like you mentioned we can't talk about because we just don't have time. But they're so valuable. And you can find things like that on the YouTube channel as well. And but come visit us there. You can also check out our book, Lifetime Tax-Free Wealth, The Real Estate Investor's Guide to the 1031 Exchange. I kind of put 25 years of love into that.
Perfect. We will link all those in the show notes. And then Dave, thanks for coming on.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.